people have seen. Silicon Valley Bank, maybe when they were leaving work on Friday, they saw, hey, it's being closed.
Because of the way the interest rates were for a long time and
going up.
And inflation, they had taken some of their deposits and put them in long-term treasury bonds and other bonds, which lock up your money for a while, but they're a relatively safe investment for the bank to generate some return on the deposits that are in their bank. Well, they started to see the value of those instruments that they had go down and had to sell some off, taking large losses to cover deposits that are in their bank, which sparked consumer fear.
Yeah, people start panicking.
And if you have more than $250,000 in an account, which many individuals may not, but companies, tech firms,
yeah, I mean, your name
VCs,
is Silicon Valley Bank. I wonder who is part of their bank.
That's a large part of their clientele have these larger accounts open that would not be protected above the $250,000 FDIC insured program.
They panicked.
They panic and they want every deposit over $250,000 out. So they start pulling money. A bank doesn't have every dollar on hand at the moment. The feds had to step in, close the bank to stop that bank from collapsing completely and people getting no money.
That was over the weekend. That happened. Then we've heard others. So there was potential that this morning we were going to wake up to financial chaos across the country. And that didn't happen.
Right. Whenever one bank, in a pretty large bank, it was the 16th largest bank in the country, has a run on their bank, consumers everywhere else start to get a little concerned as well. And the fear is that it'll spark a domino effect and everyone will go pull their cash out of the
during
bank.
COVID, the very beginning of COVID, there was tremors of this happening because people were, when there's just uncertainty nationwide, the first thing you want to do a lot of times, you feel like almost a natural recourse is go get my money.
Right.
Go get my cash out.
Treasury Secretary Yellen and a team of banking regulators have taken action, immediate action. And here are the highlights. First, all customers who had deposits in these banks can rest assured they'll be protected and they'll have access to their money as of today. That includes small businesses across the country that bank there and need to make payroll, pay their bills, and stay open for business. No losses will be, and this is an important point, no losses will be borne by the taxpayers. Let me repeat that. No losses will be borne by the taxpayers.
When you say that there will be no burden of the taxpayer, is that even at all possible?
It's a little disingenuous to me, and maybe I'm being a little bit more nice to him. It's pretty disingenuous because
we all plan to wake up to a Great Depression.
The FDIC is it's a tax levied on the deposits at the banks. So when you put your money into the bank, a portion of that is going to help fund the Federal Deposit Insurance Corporation, which then will pay the depositors in the event of a failure of a bank. So I guess if you are an American taxpayer that has no banking relationship at all, then maybe that's a fair statement. But at the end of the day, it's your deposits that then are taxed when at the bank. There's an intermediary
process of the banking system.
Yeah, we essentially are covering the deposits there. So I understand his point.
So what they're saying is this is why the FDIC exists to begin with.
Right.
For this kind of situation. This is just to an extreme level because now it's going above and beyond the $200,000.
It is. $250,000 is the limit on any individual account, and it is going to any customer at that bank.
It doesn't also mean the people that work for the banks are being protected. The people that made these poor decisions. Actually, I think the opposite is what's happening. You're saying that that it's not like the bailout in that sense. What I think of as well. I think of as a bailout. I think of just floating them to business as usual.
This wasn't caused by toxic gambling by the banks on things like subprime mortgages, all of those things that really became almost a cancer within the banking industry in 2008. This was a more traditional, they made some bad decisions based off not knowing how aggressively the Fed was going to raise interest rates and to try to combat the Biden inflation that we've been going through for the past couple years now. And so I don't think anyone would have been able to predict that fully. So we are looking at some of the fallout, though, of Biden administration policies when they spend so much government spending for years and the Federal Reserve trying to rein that in aggressively it caused some of these banks doing very traditional moves to fail.